Kia ora. Today we had the first OCR decision under the leadership of Governor Bremen. And as expected, the Reserve Bank left the OCR unchanged. But for markets and ourselves, the decision itself mattered less than the forecasts and the tone of the statement, because this was our first real chance to get some insight into how Governor Bremen's laser focus on inflation would actually work in practice. What stood out for us was a pragmatic approach to monetary policy. The bank is placing greater trust in its forecasts that inflation will moderate, rather than reacting aggressively to a near-term spike in inflation. It's prepared to let the early signs of recovery develop and take hold, keeping policy accommodative for now to support that sustained growth environment. This marks a shift from that least regrets approach we saw under Governor Orr, where policy moved quickly and aggressively with limited time to observe the reaction in the economy. Under Governor Bremen, this reaction function is different. There are likely going to be smaller moves, more time to assess outcomes, and a greater willingness to let the data play out. Importantly, a more measured approach does not mean the bank is dovish. The next move in the OCR still looks likely to be up. But the pace and scale of the tightening now appear more gradual. Rather than front-loading the hikes in response to a spike in inflation, the bank seems more comfortable reviewing the impact of its policies over time. Now that's a subtle but important change for markets. For the mortgage market, today's decision should offer some near-term relief. Rates have already moved higher on the expectation that the OCR would rise over time. But if the increases are going to be delivered more gradually and in smaller steps, the path higher might be less aggressive than initially feared. This will create opportunities for borrowers to term out their loans, particularly if they're coming from a floating rate product, given mortgages are still relatively low in terms of rate by historic standards. Overall, today's decision was in line with our expectations, but perhaps more dovish than others in the market were expecting, as some were seeing the potential for hikes as early as mid-year. We were looking for clarity on what that laser focus on inflation would mean and how reactionary the Reserve Bank would be under Governor Bremen's leadership. What we saw was a measured, patient, deliberate approach to monetary policy. The bank acknowledged improving growth. It acknowledged elevated inflation risks, but remains comfortable that inflation would come back down inside the band and that it could be patient and let growth take hold. Importantly, we also saw an OCR track that only ended at 3%, perhaps lower than some would fear. Now, this slower, more measured approach to monetary policy looks consistent with how the Reserve Bank of Australia manages policy. It might mean that we see lower peaks and lower troughs in monetary policy settings. And this is a good thing for the economy if we have a smoother OCR cycle, as it means we have more certainty for businesses and borrowers and consumers.